All righty, welcome to our Association Essentials series for July. Today, we're going to be going over association funding and loans with CIT Bank. Just a reminder, you can see our previous recordings at HOALiving.com/AES. That has lots of really great resources for all of these that we've recorded over the past couple of years with some great information for you and managing your association. So the rest of the year is going to go as follows. We've got AES scheduled for August, the end of August, financial planning, preparing for budget season. I know everybody's favorite topic. Getting ready to look forward into 2023 and budgeting. September 28th, association elections, what to know and how to prepare. And then November 2nd, Insurance 101, another really great topic to help you understand insurance. All of these are at noon. I'd like to recognize HOALiving, who was awarded a couple of different Best of State awards over at the Best of State Gala earlier this year. So we got a Property Management Award, we got a Customer Service Award, and the Employer and Employee Relations Award. We are very grateful for the chance to have been honored with that recognition. So today's presenters, we have our CEO and owner of HOALiving, Michael Johnson, and then Chuck Balacy, who is a VP Regional Account Executive for CIT. Chuck was not available to make this time, so he and Michael did record their portion of the presentation. Michael is on for question and answers as we go through. So we are very excited to get going.
Well, good hot summer afternoon, everybody. We're glad that you could join us for this exhilarating Association Essentials series on association funding and loans. Thank you, Neil, for the kickoff. And yeah, that was a great time at Best of State. We're excited to be a competitor in that every year, and the employees deserve the recognition they get. Absolutely. And once again, excited to join on a webinar, my good friend Chuck. Good to see you.
You as well, Michael.
Chuck is an avid Houston Rockets fan, and is greatly oh no, he's a Warriors fan.
Yes, sir.
He's a real Warriors fan, and basketball here in the Rocky Mountains is suffering a little bit right now. So we'll ride your coattails for a little while, Chuck. So, but the Avalanche good. Next door won the Stanley Cup the other night.
Yeah.
So, I don't know. It's all good. My Padres are doing pretty dang good this year.
They're doing good.
With a lot of injuries and not even the greatest baseball player, one of the greatest even playing this season. So we'll see. Yeah, we'll see where we're going sports wise, and then we're not too far around from football camps opening up, and we know we all love football. So
that's right.
That's coming soon. Speaking of needing a loan for the price of tickets, today we're talking about loans, and as everyone knows, CIT is our preferred banking partner. 98.7% of all our clients' funds are at CIT Bank, and Chuck is our rep with CIT Bank, and is there when we have problems, when we don't have a lot of problems, and that's one reason why we bank with them. But more important, and that banking relationship is only 3 years old now, and but for a decade before then, Chuck has been servicing our association clients with lending issues,
Right.
at least over a decade, wouldn't you say?
It's been a while, and you said it perfectly, Michael. It's, we at the bank at CIT, we like to call ourselves a specialty bank that focuses on homeowner associations and clients that that you guys manage at HOALiving, but at the same time, they're bank accounts and lockbox and all of those kind of things those are just some of the core products that we have. But a bigger discussion that continually happens is the discussion of loans. Would you say, Michael?
Yeah. Oh, it's huge, and I'm going to play the good community manager hat for a while. Wear that hat and say, if you need a loan, then you've messed up.
Sure.
But really, it's not you today who's messed up, and really no one messed up. As a country, I don't know if you've got the current stats, but the amount of money as people that we save is not enough. I think I heard the other day, if someone had an emergency bill of just even $400, 80% of Americans wouldn't be able to pay that because they don't have even $400 savings. And with inflation, and we're going to have a inflation like we talked about, AES coming up, a special one, and talk about with budgeting and all those things. But lending, and then we're going to put on the hat and say, okay, well, you've got this situation. There is a good option, and it is lending, and CIT does that better than anyone else out there. And so that's why I'm thrilled to have you with us today, Chuck.
Happy to be here.
Chuck will jump in whenever he feels like it because he's the world champion. So we'll let him do that. So when to consider a loan? Well, okay, we got planned expenses. We know they're here. We know they're coming. Loan? No, it's never ideal. If you knew it was coming, you shouldn't have to get a loan. Unplanned expenses. Okay, well, now we didn't know we had this expense. And if it really is significant enough that we notice it, it's probably significant, a large dollar amount. Loan, we're going to say last resort.
Right.
Now, Chuck on all these said yes, yes, and yes. So, but I'm community manager hat right now. Underfunded reserves. This is our biggest piece of the pie that is not there. I tell the story here in Utah when we got our first reserve legislation passed 12, 13 years ago, that probably our percentage of reserves funded in Utah was like 10 to 15% at best. We've made significant improvements because of the reserve law, which in Utah only requires lending or reserves to be done, reserve studies, and it to be communicated annually at the association meetings. And you can look at the drop down here for Arizona and Idaho information on when reserve studies are required. But so we're a lot better. I'd say we're more like 35 to 40% funded these days. But the problem is these are large expenses, and to be able to just come up with that money when you need that money, it could be trying. And so a loan might be the only option that your association has.
And I'll jump in here because I like this slide, Michael, because it kind of just it shows these different buckets that your community associations could be placed in, and hopefully you're in a position where you understand what your plan and expenses are. You know what big ticket projects the association has to be funding for, and ideally, like Michael said, you have that good manager hat on, and you are funding your reserves like you should be. Although, in reality, we have some associations that are hit with unplanned expenses, especially when, I don't know, you get hit with a harsh winter, or maybe we're talking about roofs or siding or roads or projects that didn't last as long as they were expected to. But when you combine that with an association that has underfunded reserves, then you've kind of hit that combination where, maybe increasing your assessments may not be enough, or a special assessment may be difficult to pass. And so you're looking at an option that could be a loan.
And we're going to tell some horror stories today on
Yeah.
everything Chuck just talked about and some
Yeah.
practical examples so everyone can kind of see where this ends up being. It's, you could be a 30-year-old association that tripled their assessments a decade ago to catch up on reserve funding for the last decade's been rocking it, but that roof needs replaced now. And so you didn't catch up on 30 years. You maybe made a 15 to 18-year dent by how much you did the last 10 years. And so you got to supplement that somehow. The roofs are not going to wait, or if they do wait, then you're wasting money.
Right.
Okay, planned versus unplanned expenses. And so just some examples. Planned expenses are repairing the roofs, recoating the pools, filling the potholes. Unplanned might have damage from natural disasters that aren't covered by insurance. Litigation might come up, and we got to be really careful in Utah and Arizona on there's strict rules on using reserves, using savings, votes of owners when it comes to litigation funding. And so that's something that the bank would look at, of course, and we would look at before even going there. And then accidents, all kinds of accidents and things happen. Those are unplanned. As a last resort, getting a loan might be more appealing than going to your 40 owners and saying, we need $1.6 million now. So that's 40,000 per unit. And so, write a check. If we don't have $400, we don't have $40,000. And so our resort is going and getting that loan.
Yeah, you nailed it, Michael. The key word is last resort. I'd like to kind of make sure our managers and our community associations understand that they are trying to outweigh all the different options available to them. One of them being a loan, but sometimes, like Michael had mentioned, it can be a difficult conversation to be had. But if you've exhausted every option possible, then you're doing your due diligence as a manager and as a fiduciary of your association to make sure that you're at least uncovering every option possible to come up with the funds. But if the amount is substantial and the project need is substantial as far as timing wise, we got to get these roofs fixed right now, then a loan could absolutely be the last resort and only option available.
Yeah, pop that red box around the word quickly. If you need the money quickly, and now a loan doesn't have, it's not overnight loan, but it's still going to happen faster, and especially if you're professionally managed, all your ducks are in a row, it's going to be significantly faster than trying to collect $40,000 from all 40 units.
Right.
And when we say it allows association to increase the monthly assessments by a more palatable number, I mean, what are we looking at? What are our term options on association loans these days?
Yeah, and that's a great point, because the timing is the key. A special assessment could be that large lump sum amount that could be due in 30, 60 days, very quickly, and sometimes that could be hard to stomach for a homeowner. But when you're talking about a loan that's for the homeowner association that the entire HOA will borrow, that is spread out over multiple years. We can do terms as such as 5, 7, 10, sometimes even as long as 15-year terms. And so these are a long-term loan that makes that smaller monthly payment more stomachable to be able to digest. And it is money still coming out of the pockets of homeowners to pay for these projects, but at the same time, we're asking for a smaller number over time as opposed to a large number right now.
And I know someone is typing this right now in the questions. What would get someone a 15-year term? Is it the dollar amount, how large it is?
There's a few different factors. Dollar amount is a key, especially when you're talking about multi-million-dollar loans, which we've done. It's not an issue, but yes, spreading that large dollar amount over time, over 15 years, for example, that helps get that monthly payment a lot more manageable, and then breaking that amongst the homeowners is a lot easier. But also sometimes the project itself, whether we're talking about fixing the roofs or the pools or large landscaping projects, we also want to make sure that the timing of the loan matches the timing of the project.
Yeah, very good. Yeah, so basically for a $300,000 loan, it's not going to be termed over 15 years.
Yeah.
Yeah.
You got it.
So whether it's planned or unplanned, two options, right? The collect up front, the loan with smaller payments. I think we've beat that into the ground. And both involve special assessments or assessment increases. The money has to come somewhere to pay that loan payment. And so the association has to have the language or have passed it to make it part of their regular monthly assessment or a special assessment, right, Chuck?
Right. Yeah, that's exactly right. I like the slide because you're really showing the two routes to take, because you may have amongst all of your homeowners in an association, maybe there are some that can write their check and pay their share of their portion right then and there. That is great. But for the rest of us that cannot do that, we still need the loan to be able to cover the entire association. And then you're giving your homeowners the choice. Are you able to pay your share up front and write your check? Great. If not, we're asking for smaller payments over time. But regardless of which option that you choose, lump sum versus smaller monthly payments, the HOA, the association, will get this loan to be able to make the repairs to get the project done. And then the association will pay that back over time.
And what is my choice, Chuck? Smaller installments paid over a long time. Why pay today what I can pay for the next several years?
Exactly. Yeah.
All right. So it's all about being proactive. And when it comes down to it, loans are often better than Band-Aid fixes. Band-Aid fixes are expensive. Loans do the whole job. So might be better for the association to take out a loan and replace that clubhouse roof or the common area asphalt than just patching holes over and over and filling the cracks. And so it's being proactive, not wasting money on a short-term basis for repair after repair after repair after repair. I'll give at the very end of the presentation, I'll give the ultimate nightmare example of that and why getting the loan is a better idea, but still was a nightmare. Communities, never ideal for the planned expenses. If you know they're coming, make them part of your assessment, and then you're going to have the money you need by budgeting for it. But loans aren't always just for emergencies. Once again, better to do the whole job instead of just part of the job, and not letting the issue snowball. So what's the best option? Well, avoiding loans altogether. And as a professional, Chuck would agree with that. The bankers would agree with that. Chuck would make minimum wage if that was the case. No, I'm just kidding. But we all know that's how banks are able to fund operations and do all the great, how they're able to have the lockbox and have association banking at no charges. It's because of the money that comes in off the loans. We understand that. So that's in an association specialized banking division. It's no different than any other consumer or business lending at any other banking operation. And CIT, First Citizens, does plenty. I'm sure they do way more lending in the non-HOA world than they do in the HOA world.
It's true. We specialize. Just what I do is just on homeowner associations, and you kind of said it best. The best run homeowner associations out there are the ones I don't talk to about loans. They're the ones that have a great management company, that have a great manager, that have done the reserve study like it's showing here, and are funding that reserve study properly, avoiding the loans altogether.
And you know, for those of you who haven't met Chuck before, he is located out of the Vegas area, home of the UNLV Rebels mighty powerhouse college football program. And oh yeah, they have an NFL team now too, which broke my NFL team heart at the end of the season. But it doesn't matter. Chuck loves St. George. Chuck loves Salt Lake. He loves Park City. He loves Logan. He will cover all those areas. And if we're talking a multi-million-dollar loan, you're going to see Chuck or Tony's pretty face up here to meet with your board at no cost to go over those options.
Absolutely.
Let's talk about reserve studies real quick. And, you know, it can really help us not have to have lending. For those of you, we have some great AESs on reserve studies and reserves. And so please feel free to watch those. But for those of you, this might be your first time joining us, or you haven't seen those programs, let's talk about what a reserve study is. So it's an analysis of the cost and timeframes for anticipated replacements of common assets. And it's over 30 years. It's a 30-year plan. And so, you know, 5 years from when the place is built, and every 5 years, you're going to have to take care and do some seal coating on the asphalt. In 10 years, maybe all that, well, replenish the playground mulch. I mean, it blows away basically a month after you put it in there in the first place. So, but if this is more of a permanent type of mulch, that needs redone every 10 years. Asphalt surfaces, again, every 5 years. Repaintings, railing, replacing pool equipment every 10 years. And then at 20 years, that clubhouse needs refurbished, and there's the landscaping, the irrigation needs done, playground structures, painting and siding and rock services, all those on your buildings. And then once again, we're just repeating again at year 30, some of the things, they're on a schedule, they're done on a regular basis. The reserve study looks at your assets and then gives you that 30-year outlook. So in the reserve study plan is how much should you already have in your fund today? And I'm going to show you some examples. How much should you be saving each month to keep the funding going? They're going to look at your governing documents, see what the requirements are. They're going to come to a site visit. It's required in Utah every 6 years. And they're going to just kind of look at the whole financial situation, your banking accounts, how much you're able to add on a monthly basis. And then they're going to put it all together. Use a reserve study. The Utah law is interesting, different than Arizona law, in that it says the word reserve analysis. The legislature didn't want to force you to hire a professional reserve company. They're saying, look, a board could make phone calls and call a roofer and call a pool company, get the current prices, do a spreadsheet, figure it out over 30 years. That is definitely an option. It's not best practices, not a recommendation, but the law in Utah does allow that. There's also through CAI and at CIionline.org, you can search for those with the RS designation, and the RS designation is a reserve specialist, certified reserve specialist. And that's someone that's like a PCAM in our community manager industry that has reached a big threshold. And you know, I know Dale Gifford with Complex Solutions located here in Utah, Rob Forney, same company down in Vegas, or have that RS designation through CI. And so that's definitely something we would highly recommend. Why use the, go ahead, Chuck.
I was just going to add, I mean, the reserve study is a vital tool. You know, I talked about it earlier when I said that the best associations are following that study. The bank, when it comes to getting a loan as well, is going to require a copy of that reserve study. You know, we want to see exactly what projects kind of are on the docket for that community. You know, if we're talking about one project, but we see that the roofs or the asphalt, they're coming up later on, and like you said, in years to come, we want to make sure that the association is not only getting enough funds to handle whatever project they have in front of them now, but also are setting themselves up for financial stability moving forward as they go along.
That's an excellent point. So basically, you don't have a reserve study, you're not getting a loan. So that would be part of the process. And the reserve companies are way behind. if you need to order one today, it could be 5-6 months, or you're paying a rush fee, which would double or triple the cost and slow down your loan. And so it just always stay current on these things. As you can see, it's state code, it's unbiased, it's a third party. So we're taking some of the liability away from the board. That's why we as management don't do them. We want this professional third party company to come in here and make that recommendation. Chuck, does the bank take a reserve analysis that's been done by the board in lieu of a reserve study, as long as something's been put together? Do you know?
In my experience, I mean, it's the same as just gathering all the documents. Going through that underwriting process, your life is going to be a lot easier when you're working with a professionally done reserve study, professionally done, sometimes CPA prepared financial statements, or a management company's professionally prepared financial statement and budget, as opposed to documents that were just kind of put together. That makes it even difficult for the bank to analyze and sometimes even comprehend and approve a loan based off of documents that are hard to understand.
Yeah, very good. So loan avoidance means when needs arise and money's available, we avoid deferred maintenance. We avoid sudden large assessment increases. We're avoiding special assessments. We're avoiding loans. That's from getting reserve study and following its recommendations. Yeah. Full budget process, that we go through with all of our associations, and we do have that budget AES coming up before fall budgeting season. You plan, you gather information on expenses, you review the expenses, operating and reserves, and then you set that assessment amount. And the annual operating expenses are a small portion generally of what is needed in the reserve side of things. And so have that reserve study, absolutely. So here's the examples. This is why your loan is such a great option, because you simply don't have any other choice. And these are numbers from real associations that I've pulled. The guilty shall remain anonymous. Yes. And I'm tinkering with these a little bit, but this is a typical cover page or summary page in what you see in a professional reserve study. It tells you how much money you have. I'm all pointing to it like they could see it, but it tells you how much money you have in the bank at the time, how much money you should have for what's coming up in the next 30 years today, what your percent funded is, and then how much to get to where you should be putting in on a monthly basis. So that's right. These are our numbers, but let's change this and say, instead of that $6,500 a month, $6,435, this association gets a reserve study and is putting in $0. Now they totally can do that in Utah. They can make the choice. This has been disclosed to them. They can say, we're not funding it. Okay. As long as they talk about it, that is something the code in Utah at least allows them to do. Well, what's the net result of that then? So this is another example from a reserve study. It gives you the 30 years. Here's the next decade. And you can see in here that here's our reserve expenses, right? So that are coming up, and we're putting no money into reserves every year. Well, that you're like, oh, we have $220,000. We're sitting pretty. That's so much money. I've never, I've only had $400 as a consumer. Well, look, your expenses coming up each year. Just this year, you have $176,000. You've now depleted your money, and look how short you would be. I mean, this wouldn't even be operational. You're now in 10 years, $1 million short on what you need to have. And this is not atypical. Right. Associations go years and a decade without saving any money. They're deferring all this maintenance that needs to be done, and the piper's going to come calling soon enough.
This is a great example of what we see an association coming to us for a loan, is because exactly that, Michael. They had some money in reserves. They got the reserve study done, but at the same time, they did not contribute to the reserve account like they should have. At the same time, you couple that with roofs or other components and asphalt that are being neglected, and then also their useful life not lasting as long as possible, as long as they expected. And then when they are finally hit with that bill that says, yeah, we need to fix this project now, and you go back to the reserve account and there's not enough money in there, that's exactly when the phone call comes to the bank.
Yeah, well, and it's the same time the phone call comes, hey, we've been self-managed for 25 years, and now we're in big trouble. Will you be our management company? It's the same thing. It's a panic situation. Let's look at that same scenario, right? So these are the same expenses, and the association decides that they're going to put $90,000 a year into reserves. Well, look at that. Over 10 years, they have the money to pay almost everything. They're just $162,000 short at the end of the time. So this association, we're going to say, has 36 units. To get $90,000 in the bank each year, which almost gets them there. That's $208 per unit if they're all paying the same exact assessment. And we know that isn't always the case in our condo communities. That's, $208 increase is a lot. Their current monthly assessment is $474, and the reserve contribution would be $208. They are having to increase it by 44%. That's a big increase, but this association is biting the bullet ahead of time. But is it doable? It really probably isn't, and that's why we want to look at the lending option. So if we're looking at this, underfunded reserves plus the deferred maintenance, now I've backed out the dates 10 years, and you can see, here's 13 to this year, what's been done. And now we have, instead of doing these, right, we've deferred all this maintenance that needed to be done. That's $900,000 worth of maintenance, basically, that should have been done. Well, now we have the 36 units, and it's a $900,000 loan. I don't know if they'd get 15 years or not, but let's say it was 15-year, say interest, they probably could. So interest at 5.2%, that's going up just as fast as the gas prices are, but it's still, for a business non-property collateral, its future assessments is really the collateral. That's a pretty dang good interest rate. And when inflation goes down, the interest rates will go down too. But even at 5.2%, which is the most Chuck and I have seen in a long time, it's still a killer deal.
Right. And like you said earlier, Michael, anytime that you're borrowing from the bank, whether it's an HOA loan or a line of credit or commercial loan, business loan, you pay interest on top of that. That's the give and take when it comes to these products. But at the same time, this association in this example was able to cover all of those costs, to be able to borrow the funds needed to get that done. And those costs would have never gone away. They would only continue to go up over time. And now this association is able to kind of, like you said, bite the bullet, yes, but at the same time, you're getting all of these enhancements, all of these line items crossed off the list that should have been done over time.
That's the key right there, right? So the $200 per month, the assessments would have to go up for this loan is pretty close to what if they would have saved, that it's about the same. However, they're getting it all done right now, where it would take 10 years doing it the other way. And so that is, for a little bit of interest, I think you're easily covering the cost of the interest by not having all the extra repairs you would have to do while you're waiting to save the money on something that already needed replaced 8, 7, 10 years ago.
It's a great way of putting it. Absolutely.
Okay, so that's a great example and a time to do it, and you can do a lot. Now, the thing I don't point out here, right, and Chuck mentioned it earlier, the bank's going to look at your reserve study and, okay, you needed $900,000 to catch up, but for the next 10 years, you also have projects that have to be funded. So
Right.
that money has to be somewhere, because the bank, the collateral being the association, is not going to give them a bunch of money when, you know, to fix the left side when the right side's falling apart.
Right. Yeah. Like we said earlier, you know, we're always going to do our due diligence. We want to make sure that our clients are getting the loan to get the funds they need to do that project. But at the same time, the plan is to get back on track financially to not ever have to get a loan again.
Yes, yes, I love it. State laws. Let's look at, these are our Utah laws then on lending. These are laws on lending. And I just wanted to show a little bit here. The Nonprofit Corporate Act, and right, we always say file as a nonprofit corp, file as a nonprofit corp, file as a nonprofit corp, because the association two statutes don't really deal with lending. It's
Right.
in the Nonprofit Corporate Act, and it says right at the beginning, unless its articles of incorporation provides otherwise, one of the many things, see all the things they can do, they can borrow money. So the bank is going to look at the governing docs or the articles of incorporation, and if the articles of incorporation say, no, you can't borrow money, they're not like going to say you can't do it. They're going to say you can do it, but it's going to require a vote or some kind of mechanism. And so, but you don't need to have it expressly in your documents, because if you're a nonprofit corporation, you're covered. And similar statutes otherwhere in other states. In the governing documents, here's some of the language that you're going to see. And, you know, there's a definition of common expenses, and the definition's always, well, this says one of the common expenses with all these other things is the payment or repayment of any loan to the association or association debt. The bank is going to look that you have this kind of authority to put yourself into a loan. So that's, you can find language like here. There's also in the bylaws, the board will have specific rights. And so here, specific power, secure and approve loans. Sometimes there's an actual loan section in the governing documents. And this says the board may receive loans. However, loans in excess of the annual assessment amount per lot or dwelling shall be approved by a majority of those present in person or by proxy at a special meeting called for such purpose. So there's a lot of information here. This isn't the monthly assessment. If my monthly assessment's $400, then the annual assessment's $4,800. Here, the board, maybe it's 5 people, a majority of them, 3 of those 5 people could bind every unit owner to a loan of $4,799 without going to a vote of the owners. Now, is that that's a little too close? I probably wouldn't do that. Have some town halls, but then also look what the approval authority is here. It's a majority, but not a majority of every homeowner, a majority of those who come to the meeting that is called for that purpose. So you have 200 units and no quorum requirement, and 20 people show up, 10%. That's a pretty good meeting. Now that means 11 people out of 200 could approve a loan for $10,000, $20,000. I'm not saying it's bad language to have, but you need to understand and know as the homeowner what is available in your community and what kind of powers the board have. I wouldn't be an advocate for restricting these. I'd be an advocate for saving money now so your association hopefully doesn't have to get a loan.
Yeah, this is a great time to explain that every association has unique governing documents. And so the bank, just like we talked about the reserve study and the financial documents that we're going to require for a loan, we absolutely will require governing documents, articles, bylaws, declaration, amendments to all of those documents. We're going to review it all. But this is also a great time to notate that if you are an association that is considering getting a loan, pull those governing documents out, review your own documents, schedule time with your attorney if you need to make sure that you're doing your due diligence to make sure it's done correctly.
Yeah, and the bank's going to say, if you have this provision and say it is a $10,000 loan, the bank is going to want to see the certification
Correct.
of that meeting being held properly, of a vote being taken, and of a majority of the people saying, yes, go ahead.
Correct. Correct.
Okay. And does the bank still have, does the attorneys association attorney have to write a letter or be a part of that process?
I would say it depends on, it also depends on the governing documents, but it also depends on the loan amounts, especially when you're delving into the larger multi-million-dollar loans. We absolutely require attorney opinion letters for some of those multi-million-dollar loan amounts.
Yeah, anything less than $999,000, Chuck just writes a personal check to the association. So
yeah.
The management perspective. So how does all this affect your relationship with us? Well, we start off right at the very beginning. When a new potential client talks to us, a couple of the questions are you in the process of repaying or shopping for a loan for your association? And are you currently special assessing or have one planned in the next year? If yes, our proposal will include a higher management fee to your association. Loans and lending and special assessments are difficult to track. And what happens is I'm in the middle of a 5-year loan repayment special assessment for my association. I'm 30 months in and I'm selling my unit. Mm-hmm. Well, okay. So the buyer was going to say, I ain't paying your loan. I'm not going to pay it. It's all negotiable.
Right.
But these kind of decisions that are happening can affect your management and therefore the management fee. And the biggest thing I'd say is we love that our association clients are always trying to be so flexible for their homeowners. But if you come up with, some owners get to pay up front and they pay a lesser amount. Some people get to pay twice a year. Some people pay once a year. Some people pay quarterly. Some people pay monthly. Look, it doesn't matter how good our accounting software is. None of them have the option where we can put 10 different payment scenarios on a special assessment. And so just know if you're going to give a lot of different payment options, there's probably going to be extra administrative fees to those owners. The bank doesn't care how they get their payment. The bank is not billing the 40 individual homeowners. They're billing the association, and they're billing them every single month, and they expect that payment every month. The bank doesn't care if with inflation happening and gas prices up, delinquencies are increasing right now. And so the bank doesn't care if 8 of the 40 homeowners haven't paid their special assessment for the month. They want their payment.
Yeah, so this is the perfect time to kind of delve into that conversation, because you're right. This loan that we provide is an HOA loan. This is a loan between the bank and the community association, not any individual homeowner or any individual board member. We make sure that the HOA is making their payment back to the bank, but it is a relationship between the management company and the association to make sure the individual homeowners are on track making their payments, which means that this is absolutely extra work on the management company. The reason why I like this question is because I've never seen it before. I've never seen a management company be proactive about asking the question, do you currently have a loan? Are you in the process of getting a loan? Because HOALiving has years and years and years of experience getting HOA loans. It is a lot of work. Let's not sugarcoat it. We're talking about getting the town hall meetings together, the loan package, the underwriting, the back and forth between the bank, and then once a loan is processed and completed, the logistics behind getting all of those homeowners to correctly make the right payment. And then in addition to all of that, the ones that are paying up front versus over time and everything in between. That is the part where it's the years of experience that show exactly which management companies know what they're doing about loans and which ones don't.
Yeah, and we don't mind it at all. it's just, there's some cost to it sometimes. And so
Right.
that's why we asked the question. I was going to add one other thought to something you said. It'll come to me, but the payments to the bank each month, those, correct me if I'm wrong, but those are automatic. Those are ACH pooled, right?
So yeah, we've done both. We have some loans set up on automatic payments where we just are deducting that payment every month out of the HOA account. But we do have some structured differently where those are manual payments made to the bank. We prefer to go automatic, so that way you don't have to worry about missing a payment. But those are customizations that we can work with the specific association on.
Yeah, very good. All right, so next steps on the reserve study side. If you need reserve study, right, get the reserve study updated. They are behind. It takes them a long time. After the reserve study, determine your funding goals. What's your course of action going to be? Are you increase the assessment, special assessment, or loan? Create and adopt a policy for the collections of the loan. So if you go to our May AES, we talk about resolutions. You got to have a resolution for whatever you decide to do. You're going to put it in writing, you're going to adopt it, and you're going to communicate that out to the homeowners through that process, communicating that policy to the association. The worst case scenario is a community that right at the beginning of our company's time, this is a little condo community called Heritage View in Provo, Utah. 2 buildings, 18 total units in those buildings. And you see right there that beautiful, pretty good looking membrane roof on there. Yeah. Well, when we took over in 2002, the building was 30 plus years old and the roof was in bad shape. Now, these are very humble units. It's there by Seven Peaks, the old Seven Peaks Water Park, 18 units. They were 1 bedroom, 600 square feet. And the retail value in 2002, right, before the Olympics, was $69,000. Can you imagine? I'd buy all 18 of them right now if they're $69,000. The HOA assessment, when we took over management, was only $60 per month, $720 per year. And so their total budget as the association was only $12,960, right? Now we wouldn't even be able to offer them full service management. They would go to our accounting division. The annual, they were spending out of their $12,960, $3,000 a year in roof repairs. Because every time, it's a flat roof, membrane roof, and every time it would rain, it would, and it probably actually wasn't membrane, it was like a tar and rock back then. And so $3,000 a year for all the roof and the water damage that was coming into the units because it needed replaced so bad. The new roof was $36,000 back then, $2,000 per unit. Okay, so $2,000 per unit on a $69,000 value property. That's like 3-point-something% of the total value. This was a nightmare scenario. They had no choice. The roofs, the roofing people said the roofs were going to start falling in on units. And so they had to do this special assessment, and everyone had to pay it now. I mean, the winter was coming. Out of these 18 units, 2 of those 18 units had no possible way to make the payment, and they lost their units to foreclosure to the association because they didn't save, basically $1,000 a year total for the association over those 30 years. $1,000 divided by 18 units, that's just not a lot of money. It would have been just $40 a year, right, per unit, $3.50 a month. If the owners would have had that money in there, they could have repaired that roof, and they probably would have saved $12,000-15,000 in just roof repairs and leak repairs over the last 5 years before we had taken over management. It was it was a heartbreaking, horrible situation. We took this situation to the Capitol when we were dealing with the reserve laws, and there is no requirement, like I said, on reserve funding, but this is the nightmare scenario. No one should lose their home, as humble as it is, because you didn't save money over time. And this, you know, they wouldn't have had the money to pay it anyways, but definitely, you know, back in 2002, probably could have got a $36,000 loan from the bank and help stretch that out, right? And this is even, I think our first contact with association banking for us probably came in 05-ish, 06-ish. And so the loans back then, the only option were, and this is what I was going to say earlier, the only option was a member of the community would have to go down to your local community bank, you know, your Zion's bank or whoever. I'm not outing Zion's or anyone, but they'd have to go down to them, and the homeowner would have to use their social security number, their personal credit as collateral for this association loan.
Yeah.
That doesn't have to happen anymore. That's why there are HOA specific banks and banking divisions. That's why Chuck is here to guide you through the process. No one should lose their property over it. And it's that's why I love shopping local. Chuck loves shopping local. We love shopping local. But going to these association banks, they figured out how to do this, folks. They give you great banking services and lockbox services. And you have to send your payments to Arizona now, right? But if CIT had they could open a PO box up here in Utah and then have to FedEx it every night to Arizona anyways, or wherever it was, which is what some banks do, then that makes maybe in your interest rate on your loan is now not 5.2%, but it's 7.5%. Like all these things work together. Chuck, this is your time. I mean, you know, I love you. I love the services of CIT, but for those of us, those doubters out there who are watching this, and we put these free on the World Wide Web for anyone to watch, you know, why go get that association loan?
Yeah, it's everything we've talked about. You know, if you're a board member of your association or community manager of an association, and you're seeing the signs of underfunded reserves or neglected projects like roofs or asphalt or siding, and then you combine that with maybe you aren't able to collect 100% of assessments all the time. You, as board members and as managers, you are fiduciaries of your association and financially should be responsible for doing what's best for the community. A loan may not be the best option because, like we talked about, I want to make sure that you are weighing everything out, whether it's increasing regular assessments, doing a special assessment, a combination of those. But in the end, if you're in the position of wanting to at least outweigh every option you have, a loan could be an option for the association. And it's more about having the conversation to say, what would it look like for our community to borrow $900,000 as opposed to special assessing that amongst everyone else? So the main takeaway is, if you have an association, if you're on the board, if you're managing an association that you think might even consider getting a loan, start the conversation now. Reach out to the bank and have that initial meeting, whether it's in person or virtual. I'll be happy to come out and have this conversation to make sure that everyone is aware of the option available to them, and then have the board make a fiduciary decision as to what is best for the community and its homeowners. Right.
Largest loan you've done in Utah, largest amount of loan you've done in Utah?
We've done some large ones. You know, unfortunately, because there've been some large projects and large neglect. But at the same time, you know, we've had I guess you could say the pleasure of being able to come up with a $3 million solution to an association that didn't have $3 million available to them in the bank. But when you can say that a community has been approved, and that sigh of relief to the board, to the membership that says, hey, we're not going to lose our home. We're not going to have to fire sell and get out of here. We're going to be able to have a plan in place to not only get the money we need for the project, but also to make our community a better place, a more financial stable place, and a place that people want to buy into, live in long term, and keep those values up. That's the main purpose of a loan. The final takeaway I'll mention is don't forget about the bigger picture here. We live in homeowner associations because we value the way that this structure is in place, and the way that our community gives value to our individual investments, our homes. And if a loan can be an option to protect that value, protect that investment, then I'll be happy to provide whatever I can do to make that happen.
So in this environment, I won't say what's the least amount of a loan you've done, but in this environment, what would the least dollar amount loan be that would kind of make sense right now?
Yeah, I mean, it's very common, especially right now, for associations that are looking for, anywhere from a $75,000 loan to a $250,000 loan. These are smaller scale loans for the bank, but can be substantial savings to the HOA that needs that kind of money to make large repairs. So regardless of the amount, whether it's a small loan or a multi-million-dollar loan, you're going to get the same service regardless, and you're going to get the same attention regardless.
Right. What is there a loan origination fee on top of the interest, obviously, but is there a loan application fee, and is there a loan origination fee?
Yeah, great question. And these are, these are custom to the association, and also the dollar amount. Keep that in mind. The larger amounts come with a lot more work. And so you might see origination fees sometimes on the larger loans, but especially for our smaller loans, especially if we can fit them into what we call a quick term loan product. A quick term loan product has no origination fee. There is what we call a commitment fee to make sure that the bank gets their fee to make sure that we're processing and underwriting that loan. But some of these smaller loans are not going to have that origination fee.
Okay, appreciate that. Well, I'm going to turn the time back over to our great education committee for some Q&A. And Chuck, thank you so much for joining us today. I always enjoy doing my presentations with you. Let's start like an MBA podcast or something. We're pretty dang good at this.
Let's do it, Michael. You and I just talking NBAs, just sports in general. I'm for it.
Literally tens of people would watch. All right, Chuck, have a good day.
All righty. Well, that was great. Some awesome information on association funding, some of the options that are there. We've got some hands being raised, so let's find that. Bruce, what is your question?
I'm kind of interested in what your organizational structure is as a company. I know you have projects in Utah, and I guess you've got them in Arizona and elsewhere. What's your organizational structure look like?
Yeah, great question. You're welcome to send me an email at michael@HOALiving.com, Bruce, with your contact information, and we can talk offline about that. So thank you.
So it's Michael at HOA Living.
Yeah, Michael at HOA Living, MICHAEL at HOALiving.com, and I'll give you a call as soon as right when we wrap up.
That'd be wonderful. Thanks, Michael.
Bruce. Thanks for joining.
Thank you.
All right, any other questions on the association funding, the loan process? Again, Chuck was not able to attend, so that was a recording, but I think Michael and I have both gone through a loan process or two in our time here with HOA Living and the HOA Living companies. So we could probably answer a couple of those questions.
Oh, good. If none have come up now, feel free to email your community manager and they'll get it to us or to Chuck to answer. But we're sure
Yes.
grateful for everyone for joining today. Next month, right? Next month is budgets, and we're going to talk about inflation. Be prepared for some sticker shock. Unfortunately, we're seeing dramatic price increases in everything from insurance to landscaping. It all trickles down eventually, and be prepared for some assessment increases for 2023.
All right, Alan, before we hop off, Alan just threw up his hand. Alan, what's your question?
So how do we get access to the presentation today if we want to show it to other board members?
Great question.
Yeah, this is, it takes a day or two for us to do all the back end processing, but then you can visit HOALiving.com, and then under the resources section, there's some education, and all of those links are available for all the AAS, including this one. This should be up by Friday.
And when you said next month you'll do budgeting, what's the date next month of
Yeah,
the
that slide, Neil, that slide for the next
Yes.
presentation is the 20, is it the 24th? You don't want to,
Yeah, I don't want to go backward too far, but that will be August 24th. Yep. August 24th is budgeting. September 28th is elections. And then November 2nd will be insurance 101. And then we'll break for the holiday season and resume these next year, 2023.
August 24th budget, September 28th elections,
Yep.
yep.
and the
then
next one,
November, yeah, November 2nd for insurance.
insurance. All right, appreciate that. And those are expected to be noonish presentations
Yep,
again.
Yep. Yep. Try doing about noon. Thanks, Alan, for joining us today.
Thank
Okay. Well, thank you all for joining. Again, we very much appreciate your time. We understand that this is a time investment in you and your association. And while the associations maybe don't know it, they are grateful for the efforts that you are putting in to become better educated and a better leader for your association. If you had a good time today, it would be great if you could leave us a positive Google review. We really appreciate those. And we thank you for your time.